Let's talk about a performance gap so wide it demands an explanation. Over the last 4 years, the S&P 500, the benchmark that most professional fund managers fail to match, has delivered a respectable return. Investors who simply bought and held the index are likely very satisfied. But what if I told you there was a portfolio that didn't just edge past that benchmark but obliterated it? A portfolio that has returned over 400% since inception and is sitting on a roughly 90% gain in just the last 12 months. This is not a hypothetical backtest. This is not a high-frequency trading algorithm that's inaccessible to the public. This is Alpha Picks, a quantitative stock selection service powered by the team at Seeking Alpha. On the dividend desk today, we are dissecting exactly how this strategy works. We're moving beyond the surface-level numbers to understand the quantamental philosophy driving these decisions. Because here's the fascinating part, this algorithm doesn't know the names of the CEOs it's investing in. It doesn't watch keynote speeches or analyze product launch hype. It looks strictly at the data, and in doing so, it has managed to outperform the vast majority of human intuition on Wall Street. The following content is strictly for educational and informational purposes and is not investment, financial, or tax advice. The Dividend Desk is not a financial advisor. As always, please do your own research before making any investment decisions. To understand why Alpha Picks is so effective, we need to understand the brain behind the system. The strategy is overseen by a quant team with deep institutional roots, led by a strategist who spent over 35 years navigating the worlds of Wall Street and the City of London. We're talking about the kind of experience that comes from running a proprietary trading desk at Morgan Stanley for over a decade, serving as the head of international global investments at Northern Trust on the asset management side, and eventually founding a hedge fund and a fintech company. That fintech company, interestingly, was building autonomous data-driven stock selection systems long before the term AI became a marketing buzzword. This deep background eventually led to an acquisition by Seeking Alpha about 6 years ago, merging advanced quantitative analysis with Seeking Alpha's massive qualitative news ecosystem. So what is the secret sauce? The team calls it quantamental analysis. For the average retail investor, stock picking usually involves a mix of reading earnings reports, looking at a P/E ratio, and maybe having a gut feeling about a product. The quant system at Alpha Picks strips away the gut feeling entirely. It focuses on 5 core investment characteristics that have been empirically proven to drive long-term outperformance: value, growth, profitability, EPS revisions, and momentum. Now it's crucial to understand that this isn't a simple screener where you just filter for a low PE and high revenue growth. The system covers close to 5,000 stocks. Every single day, it refreshes the data for every single one of those companies. It doesn't read last month's news. It processes the balance sheet, the income statement, and the cash flow statement as soon as that data settles. The system assigns scores based on hundreds of underlying financial metrics relative to a company's specific sector. You're not comparing a tech stock to a utility, you're comparing it to its direct peers. Based on this rigorous daily ranking, the system issues a recommendation: strong buy, hold, sell, or strong sell. On any given day, out of those 5,000 stocks, the system might identify approximately 380 to 400 stocks as strong buys. And here lies the practical problem for individual investors. No one can manage a portfolio of 400 stocks. This is the paradox of choice in quantitative investing. The raw power of the quant system is overwhelming. Alpha Picks exists to solve that paradox. The team applies a layer of focus over the raw data, filtering the universe of 400 strong buys down to the 2 most compelling opportunities every month. On the trading days closest to the 1st and the 15th, the portfolio welcomes a new stock. This creates a concentrated, high-conviction, yet deeply diversified portfolio over time. A common misconception with quantitative strategies is that they must be high-frequency, high-turnover beasts. The Dividend Desk is here to clarify that Alpha Picks is designed for the exact opposite. It is meant for long-term buy-and-hold investors. In an era where hold ratings are often ignored, Alpha Picks treats the word hold with institutional discipline. When a stock enters the portfolio as a strong buy, it's there based on fundamentals. As time passes, a stock's price may run up so much that its value factor becomes less attractive, even if the company is still firing on all cylinders. The quant grade might drop from strong buy to buy or even hold. Most investors panic at this point. The Alpha Picks rulebook explicitly states, a hold is not a sell signal. The team gives a stock a full 180-day grace period from the moment it enters hold territory. They want to see if that momentum or profitability can reassert itself. This prevents the churn that destroys returns through transaction costs and taxes. A stock is only forcibly ejected from the portfolio under strict conditions. It receives a sell or strong sell rating from the quant system, or there is a significant structural event. Corporate actions like large-scale M&A activity or the delay of a mandatory SEC filing are immediate triggers for removal. These rules are not arbitrary, they are safety valves. This discipline keeps the portfolio naturally capped, oscillating generally between 35 and 42 positions. For an investor, this is a dream scenario. After the initial effort of building a position in the current portfolio, your ongoing maintenance requires action only about 2 or 3 times a month. You are essentially running a mini quant fund with minimal required legwork. We often get asked a very logical question on the dividend desk. If the system has two favorite stocks, why not just go all in on those two highest conviction ideas? Why spread the bets across 40 stocks? This is where backtesting meets reality. The Alpha Picks team has explicitly tested this. When a position is liquidated and cash becomes available, do they buy just the top 5 strong buys, or do they spread the capital across the entire portfolio? The data unequivocally points to the latter. Buying the entire portfolio is what generates the historical performance you see on the chart. Overweighting the top 5 promises higher reward but introduces a level of single stock risk that can lead to significant drawdowns. The diversified approach smooths the ride. When one sector rotates out of favor, another rotation into the new stocks props up the portfolio. It is a rigorous application of the alpha and beta separation. Many seasoned investors keep a core of passive ETFs for beta market exposure and then seek a product like Alpha Picks for their alpha outperformance. If you're trying to replicate the 400% return, you cannot cherry-pick 3 stocks you like. You must mimic the structure. We also have to address the modern accessibility of this structure. In the past, owning 40 individual stocks required significant capital and high brokerage fees. Today, the landscape has shifted. Platforms like Fidelity, Schwab, and Robinhood offer fractional shares. If you have a stock trading at $1,600 a share, you don't need to save up that lump sum. You can buy as little as $100 worth of the position. This democratizes the full portfolio approach. For an investor starting fresh, the initial task of buying 35 to 40 fractional positions is a bit of work, but after that initiation, the maintenance is negligible. Let's ground this in reality by looking at a current example that the dividend desk has also monitored closely: Micron Technology. Alpha Picks added Micron to the portfolio back in October of 2024. At that time, the narrative around memory chips was not universally bullish. Some analysts were skeptical about the cycle, others were waiting for the perfect entry point. The quant system, however, doesn't wait for Wall Street consensus. The algorithm doesn't know that Micron makes memory chips. It doesn't know who the CEO is. It saw a company with a growth rate that was crushing the sector average, paired with a valuation framework that, despite the stock's movement, still represented a superior value proposition relative to its IT peers. The system recognized the influx of positive EPS revisions in the price momentum. It looked at the letter grades assigned by the quant model, those academic letter grades from A plus to F that Seeking Alpha is famous for, and saw a report card that was too compelling to ignore. As a result, Alpha Picks initiated the position before the massive leg up that took the stock well past the $1,000 mark. This illustrates a critical lesson for dividend and growth investors alike. If you wait until the story is perfectly clear and every analyst agrees, the valuation has usually already adjusted to reflect that clarity. The system's edge is that it acts on the raw financial data before the narrative is written. Psychological barriers destroy more wealth than market crashes. One of the hardest psychological hurdles for investors to overcome is buying a stock at or near a 52-week high. Our brains are wired to find bargains, which naturally pulls us toward beaten-down stocks at 52-week lows. The quant system at Alpha Picks directly challenges this human bias. They have run the data on this for decades, and the results are stark. If you took a basket of 10 stocks at a 52-week high and another basket of 10 stocks at a 52-week low and came back a year later, the basket of winners would have vastly outperformed the basket of bargains. Why? Because a stock at a 52-week low is usually there for a fundamentally sound reason. There's a problem with the company, the balance sheet, or the industry. Meanwhile, a stock at a high is often climbing a wall of worry, supported by strong fundamentals. The momentum factor, which is one of the 5 pillars of the Alpha Picks strategy, is often misunderstood. Some think momentum means chasing meme stocks. That's not what this is. Empirical research tracing back over 250 years of market history shows that momentum, the tendency of well-performing stocks to continue performing well, is one of the most persistent anomalies in finance. The system combines this momentum factor with the value factor to ensure you aren't just buying a bubble. It asks, is the price going up and is the price still cheap relative to the growth? That combination, especially viewed through the PEG ratio lens, is explosive. Let's apply this lesson to another recent addition, SanDisk. When Alpha Picks added SanDisk to the portfolio back in February, the stock was around $649. It has since climbed to over $1,600. The gut reaction from a human investor would be, I missed it. The quant system says otherwise. SanDisk remains a strong buy. If you pull up the quant grades for SanDisk right now, you are met with a perfect report card. It has an A for value, an A for growth, an A for profitability, an A for momentum, and an A for EPS revisions. It is incredibly rare to find a company in the IT sector with a valuation grade of A. That single letter tells you instantly that despite the massive price run, it is still cheaper than the sector median. Let's get specific with the numbers. On a price-to-earnings PE basis, SanDisk trades at a multiple of 25 times. The sector median is 32 times. That's a 21% discount to the sector. But the story gets better when you look at the PEG ratio, which is a favorite metric of the quant team because it marries the price-to-earnings ratio with the growth rate. A PEG ratio of 1 is considered fair value. SanDisk is trading at a PEG of 0.8 times compared to the sector's 1.42 times. That means on a growth-adjusted basis, SanDisk is trading at a massive discount. This is why the algorithm is holding firm. It is not selling because stocks don't go up forever. It is holding because the fundamentals, refreshed every single morning, still indicate that this stock is undervalued. The strategy also reveals its discipline with a stock like AppLovin. AlphaPix added AppLovin to the portfolio way back in November of 2023. At one point, the position was showing a return of over 1,500%. Recently, software stocks have faced a brutal rotation, and AppLovin has corrected significantly from its highs, near $728 down to the $510 range. When a high flyer corrects, the question becomes, is this a broken thesis or a healthy pullback? This is where the daily refresh of data becomes an investor's best friend. A sell-side analyst might issue a note on AppLovin, and that static PDF might sit on your desk for 8 weeks. In 8 weeks, the valuation framework and market sentiment can change completely. The AlphaPix system doesn't sleep. Every morning, it runs AppLovin through the hundreds of metrics. If the fundamentals erode, the rating drops to sell and an alert goes out immediately. If the stock falls but the fundamentals remain strong, if the growth, value, and profitability characteristics still outpace the sector, then that dip represents a dislocation between price and fundamentals. With AppLovin, the system adhered to its winner's management protocol. When a position appreciates more than 100%, the team often trims the initial exposure to manage portfolio weight, but retains a core position as long as the ratings hold. This allows the portfolio to keep riding a secular winner, even if the journey is volatile. For current investors, a temporary pullback in a stock that still carries a buy or strong buy rating is not a reason to panic. Historically, if fear and anxiety have caused the price decline but the numbers haven't broken, the system suggests that investors will eventually return to these strong fundamentals. Now, how should an investor watching the dividend desk approach AlphaPix? Because the channel is dedicated to high-quality research and not personal advice, we can't tell anyone exactly what to do with their capital. However, we can outline the 3 most common strategies observed among subscribers based on varying levels of time and capital. Strategy 1: the full replication maximum alignment. This is the purest approach. The investor enters the position by purchasing all current stocks in the portfolio, strong buys, and holds at equal or standardized weights. They utilize fractional shares if necessary. When a new pick is issued on the 1st or 15th, they allocate capital to buy that stock. When a sell alert is issued, they liquidate that single position and redistribute the proceeds into the rest of the portfolio. This is the only way to closely mirror the historical performance track record. It requires an initial heavy lift of research and buying activity, but becomes a low-touch maintenance strategy afterward. For the long-term disciplined investor, this is the playbook. Strategy 2: the strong buy concentrate high conviction. Some investors do not want 40 stocks. They are comfortable with higher volatility in exchange for a more concentrated punch. They filter the portfolio to only buy the positions currently rated strong buy. This reduces the number of holdings significantly. The risk here is that you might buy a stock right as its rating begins to transition and you are less diversified against sector-specific shocks. It is a higher-octane approach. Strategy 3: the research validation tool cherry picking. The third approach uses AlphaPix as an idea generation and validation layer. The investor is already doing their own homework, maybe looking at a stock like Micron or SanDisk. Before pulling the trigger, they check the AlphaPix portfolio. If the stock is in the portfolio with a strong buy and the quant grades support the thesis, it provides massive conviction. This combats the thesis drift that occurs when a stock drops 5% and you want to sell. However, the quant team warns that cherry-picking often leads to unintentional market timing mistakes. A human picking a few favorites from a quant portfolio often manages to pick the ones that take a breather first. Before we wrap up, it's vital to appreciate that this system is not static. The financial world constantly evolves, with new factors emerging and old ones fading. The AlphaPix team operates under a philosophy of perpetual refinement. They are continuously backtesting new metrics, digging for factors that possess high predictability, and weighting them against the core 5 characteristics. If a metric proves to be predictive and robust, it earns a heavier weight in the algorithm. If an old metric starts to lose its signal, it gets pruned. This is the holy grail pursuit of quant finance, a machine that never rests, consistently separating the signal from the noise so that investors can wake up every single morning to a completely fresh, actionable research recommendation. Beating the S&P 500 by 400% is not about luck, it's about process. It's about removing the emotional biases that tell us to sell winners too early and buy falling knives at 52-week lows. It's about respecting the combination of valuation, growth, and momentum, backed by tireless daily computation. If you're looking to blend your core ETF strategy with a powerful source of alpha, or if you simply want the tools to make more informed, data-backed stock selections, Alpha Picks presents a compelling, transparent solution. There is a link available in the description of this video and in the pinned comment section where you can explore the portfolio, see the quant grades, and start reading the professional research reports that accompany every single pick. Thank you for joining the Dividend Desk for this deep dive into quantitative investing. If you gained value from this breakdown and want to see this channel continue to analyze the highest performing strategies in the market, please give this video a like. Don't forget to check out our last video on Micron right here on your screen. We'll see you in the next analysis. This video is for educational and informational purposes only and is not investment, financial, or tax advice. I am not a financial advisor. Please always do your own research.